Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.
All right, so welcome to Mortgage Mom Radio. I am Debbie Marcoux. I am the Mortgage Mom. And I know it's been a minute since I have done a show. I am so sorry, you guys. So we had obviously the holiday, so I was dark there. And then unfortunately, my big girl, my Nana girl, passed away. And so I wasn't really up for doing a show that week. So it's been a couple of weeks since you guys have seen me. So I do apologize in advance. But today is going to be a great show. We are actually starting to see refinances picking up, people being able to take the opportunity to get some debt paid off. Some of our clients are still definitely benefiting from home equity lines of credit and home equity loans versus doing a complete new refinance. Many are actually at a point right now where refinancing is making much more sense with where interest rates are at. So we're going to talk some scenarios today, and we're going to discuss how did we determine what the best option for that client was. Now, I also want to say that if you are looking to purchase a home with interest rates coming down, this is also very beneficial for you as well, because it is helping people to either afford just a little bit more home at that same monthly payment, or the price range that you want to stay within is now starting to get less expensive. So all really great news around the board. We're definitely at the lowest interest rates that we have seen in quite some time. I believe I read yesterday that they said these were the lowest interest rates that we've had since March of 2023. So as you can see, this is definitely opening up some great opportunities for many people. I can see that Annette has jumped on and said happy Wednesday. So happy Wednesday to you, Annette. And again, I want to remind everybody that this is an interactive show. I would absolutely love to help you answer your questions. So if you would like to ask me something, please do not hesitate to put that into the feed. I will read it out loud, and I will answer the question for you. Every single question that you ask is beneficial because there might be somebody else out there that has a similar question or the same question. So chances are that if you are thinking it, somebody else is as well. So you are helping everybody by asking the question. So please feel free to do that. I would absolutely love to help. But again, I'm Debbie Marcoux. This is Mortgage Mom Radio. I do come to you guys once a week. This has been a very weird month for me. So it's been a couple of weeks since I have been here. I do apologize. But every Wednesday at 1 o'clock, like clockwork, for the last, I think we're on 6 years now, I am always here. So make sure that you do subscribe to my channel. Please give me a thumbs up to the show itself. That does help the algorithm. And let's jump right in. So I do want to start talking about how I've got clients right now in process. Refinances are definitely starting to pick up. And we've got some more pre-approval loan applications that are coming in as well from people who are trying to take advantage of the interest rates. And we'll talk a little bit too about next week, the Federal Reserve cutting rates, not cutting rates, and how that might change whether you want to do something today or whether you want to wait a bit longer. So let's just jump into it. Let's go. So one of the things that we do have going on, and I did make notes. I made sure that I can give you guys some different scenarios. Like I said, I wanted to try to be able to explain how we determine or come to the conclusion of what the best option is for you when you reach out and you are trying to decide how you should move forward. So in this first scenario, this is somebody that is a customer with us right now, a client that need some help, and they are trying to figure out how to get the cash that they need to pay off the debt that they have currently. So in the situation right now, and there are many out there that might be in this same situation, this client already has a first mortgage that they have tried very, very hard not to refinance because they love the current interest rate that they have, being that it is a very low rate at 3.49%. But they've already taken a home equity loan. So they've already got a second mortgage outstanding, and their current second mortgage is $100,000 at this point in time. So they now need additional money to be able to pay off the new debts that they have. So we've talked about that in the past as well. It is really, really important when you guys are looking at doing a debt consolidation loan that you are taking into account that just because you just paid off all those cards, that doesn't mean now that those cards are open. You guys have to get vigilant. You've got to be very strict with yourself. You've got to put them away. You can't continue to use them. If we are paying off the debt, we are paying off the debt because you can't pay it off yourself. And we are trying to give you a direction, an opportunity to get it paid off, increase your credit scores, have one monthly payment to get that debt, taken away. But you've got to put it away. You've got to get strict with yourself, and you've got to try really, really hard not to utilize those credit cards again. In this scenario, the client used the credit cards again. I am not going to talk down to anybody in that situation. I have personally been there myself. It has been very, very difficult with where the economy has been, with where the inflation has been, what we are paying just at the grocery store alone. So again, I understand it has been very hard, and many, many people are probably in this exact same scenario. So we're going to talk about this. So current mortgage, $5,400, so $5,432. That includes principal, interest, taxes, and insurance, and that is their loan currently. They want a new home equity loan for $300,000. So they've got a first mortgage balance, $661,000, and a current home equity line of credit with a payment of $892. So their total that they are paying today is $6,324 a month. So $6,324 is what they're paying for their $661 first, and they actually owe $77,000 on the second. I had earlier said $100. They actually owe $77,000. So they're paying $6,324. They want to either keep their first mortgage where it's at the $5,400, but they want $300,000 in an equity line. So they want to pay off the $77,000 that they owe, and they want to get the additional out in cash. They'd like to pay off some debts, possibly also do some home improvements. So they're trying to figure out, do we do a first and a second, or do we do a complete full refinance? So this is where the options were at for them. In this scenario, this client's credit score is 660. A 660 is a great credit score. We can absolutely help you to get money, whether that be a refinance or a second mortgage. But we don't have any home equity lines of credit for a credit score that is under 680. So being at a 660 credit score, now there are equity lines out there. Let me just preface that. There are equity lines out there that you can get with lower than a 680 credit score. However, they already have a home equity line of credit in place. So we're trying to refinance that equity line and get them into a new one. So with all of the investors that we utilize, we don't have an opportunity unless we actually put them into a new second mortgage. So a home equity loan versus a home equity line. So home equity loans are going to be loans that are based on a term, like a 30-year mortgage would be. It is a mortgage. It is a second mortgage. So it will be a principal and interest payment, which is different than a home equity line. A home equity line is an interest-only payment, very much like your credit card, and is based on the balance that you owe at each billing cycle. So if you pay down that balance, your monthly payment is less than it was the month before. It is a home equity line of credit. You use it, you borrow against it, you pay it back, you borrow against it. You can use it as much as you want. So again, that home equity line of credit is going to be a lower monthly payment than a home equity loan. A home equity loan is going to be more expensive because the amount that you take day one is the amount that is drawn. That is the amount of the loan. It is a principal and interest payment, and it is put together with a monthly payment just like a mortgage to make sure that the payment that you are making is going to pay it off in the term that you select. So you can choose a 5-year, 15-year, 20-year, 30-year, right? So based on a 30-year payment for $300,000, that monthly payment would be $3,057 a month. So if we do the math and you take their $5,432 on their current first mortgage, you put the second at $300,000 for $3,057 a month. Their total payment with the two loans combined would be $8,399. So let's call it $8,400. Okay. And again, this is for this client. This is based on their scenario, their property taxes, their homeowner's insurance. This is by no means your scenario, but this is a good way to explain how we determine which program is best and should we do a full refinance? Should we break it up into two loans? Do we refinance the second loan, right? So again, doing them separately, getting them the cash out that they want, we are looking at $8,400 per month for this client. Now, next option would be doing a conventional loan, doing a refinance, no mortgage insurance because this client obviously has more than enough equity to be able to take out the money that they are looking for. However, with the 660 credit score, the interest rate on the conventional refinance, cash out refinance to consolidate everything all into one loan is much higher than if we were to go with an FHA loan. However, there is no mortgage insurance with conventional. So many people call me and say, I want to do conventional. I don't want FHA. Totally get it. Okay. So I showed them the two options. This is what an FHA cash out would look like. And this is what a conventional cash out would look like. So giving them a new loan amount of $880,000 on an FHA, today's interest rate for them with their 660 credit score, with the equity that they have in their home. So again, everybody gets a little bit different something, right? But for their scenario, the interest rate today is 5.49% for the FHA refinance. We're going to pay off the first, pay off the second, and get them cash in hand. That option at $880,000 is a monthly payment of $7,079 per month. So $7,079 is absolutely less expensive than keeping those loans separated. It is more than what they pay today, but it is also getting them $100,000 cash in hand on top of paying off their current mortgage balance and the equity line that they currently have outstanding. So that was option 2. Definitely the best option so far of what we've talked about. Now, option 3 was the conventional refinance. Again, no mortgage insurance. So in that FHA loan that I just talked about for the payment of $7,079 a month, there was monthly mortgage insurance because it is an FHA loan. FHA loans have mortgage insurance regardless of how much equity that you have in the property. Conventional loans do not have mortgage insurance. However, for the loan amount that they wanted, the cash out that they wanted, the credit score that they wanted, in their scenario, the conventional loan had a much higher interest rate. So I mentioned for them, FHA, 5.49%. It has been a really, really long time since I have been able to call out a number like that on air, doing a show saying, hey, oh my gosh, we've moved into 5% range, which we have. However, in this scenario for conventional, for the loan balance, so again, $880,000. So we're talking jumbo conforming loans. We're above the county loan limits of the 766,500 for a conventional. So now we're going into different territory loan wise. We're talking about a lower credit score when we're in those more jumbo type loan products. That interest rate was 7.625. So that payment instead of FHA at $7,079 a month was going to be $77.19. So even though there wasn't any mortgage insurance, with that reduced interest rate on the FHA was the best option. So we're back at that right now. Best option, FHA, getting cash in hand, right? And paying off first and second and doing full consolidation. So then we talked about option 4. So what is option 4? Well, option 4 would be to look at, can we refinance the first and the second only, not getting you any cash out at all, but consolidating the two loans together into one? And would that be beneficial to you? Once we do that and we've paid off the home equity line of credit that you currently have with your 660 credit score, we could now still get you a new home equity line of credit instead of having to go the home equity loan route. So does that make sense for you? So we looked at that opportunity, and it actually was not a bad option. So now it's going to come down to what the client wants, right? So the option with FHA, consolidating their current first of 660, their current second of 77, was going to put them at a payment of $62.80. So how does that compare to what they pay right now for their 660 loan amount and their 77 loan amount? Right now they're paying $63.24. So the $62.80, doing the debt consolidation, putting it all into one, taking no cash out on the FHA, is just slightly lower than what they're already paying today. But it opens them up to be able to take that new home equity line of credit for the additional cash that they want. So now it comes down to the client. Now it's not me. Now it's the client. I'm showing you options. I can give you option A, put it all together into one, give you the $100,000 in cash out, all in one 30-year fixed rate loan at 5.49%, or I can put it all together, lower your monthly payment that you're paying today just slightly, but open you up for the opportunity to take that next equity line of credit out for the cash, the additional cash that you want. If you ask me, I like to have everything on a 30-year fixed. I like to have it all into one monthly payment. I think you're still going to end up with another monthly payment, obviously, on the home equity line of credit that you would choose to take after we finish the refinance of consolidating it together. So you're probably going to end up at just about the exact same monthly payment, but you'd have it all rolled into one loan at one interest rate with one monthly payment. I think that that's easier. So this is what we came up with for that client. And you can see there's lots of options. There's a lot that goes into it in determining what makes more sense for the client. But if you guys heard what I said at the very beginning, that client has a $660,000 loan amount today at an interest rate in the 3s. So you might in your mind be thinking, my interest rate is too low, I can't do anything. Interest rates have come down enough that we can start to talk about what might be an option or what might be available to you. And you might just be very surprised, like this client was, that the opportunity is there to do that refinance. So that was a very, very exciting scenario. I've got another one that is very similar that we'll talk about as well. I haven't seen any questions come up in the feed, but I am here to help. So if you have a scenario that you'd like to throw out there and you want to ask me about, please feel free to do so. We can talk about purchase as well. And I definitely still want to get to what we believe is going to happen next week with the Federal Reserve and why. And is that going to make a big difference? Should you wait a week to give us a call to start a refinance or to start a new purchase? Or do you get that started right away? So that's a very, very important topic for today as well. I'm going to take a super quick break just to run a 60-second commercial. Don't go anywhere, and I'll be right back.
She's the mortgage mom.
This is Debbie Marcoux, the mortgage mom. Well, I've had a lot of questions lately. What can I do to bring my monthly payment down until interest rates get better? Well, if you are a buyer and you're out looking at homes, what you want to focus on is a program called a 2-1 buy down. If the market rate today is 7%, you would start your first year at 5%, year 2 at 6%, and year 3 through 30 would be at that 7%. It's a great way to enter the market today, knowing that rate cuts are just around the corner. Give us a call or head on over to our website at mortgagemomradio.com.
Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926.
When you're in need and don't know where to go, pick up the phone and call Mom.
All right, so welcome back to Mortgage Mom Radio. I'm Debbie Marcoux. I am the Mortgage Mom, and today we're talking scenarios. Interest rates are falling. Who can benefit from doing a refinance right now? Home equity lines of credit, we still have those. They're great. Some people are still doing better by taking that second rather than consolidating. Others are actually definitely in a scenario where consolidating is working to their benefit. I did mention before the break that interest rates on FHA today to do a refinance, debt consolidation, they are in the fives. We just quoted today a 5.49. We are doing many streamline refinances right now for people that have purchased a home with FHA or VA over the last 18 to 24 months, who have been at interest rates that are far beyond where they are at today. So doing those streamline refinances are great for those people who already have that FHA or that VA loan in place. Streamline refinances are super, super simple. We are basically going to verbally verify where you work. We're going to get some paperwork from when you closed your original loan, and we are just going to lower the interest rate. We're going to change the terms of the loan to give you a lower monthly payment. So if your interest rate is 5.5% or higher, you should definitely be reaching out to see if a streamlined refinance is something that would benefit you. And many, trust me, so many people right now have mortgages that are well above 5.5%. So definitely something to notate. And we would love it if you'd call our office, go to my website, mortgagemomradio.com. You can put in an email to me through the contact us button. Those all come directly to me, and I respond to every single one of them. You can call the office directly. The number is 844-935-3634. So definitely take advantage of that. If you guys have an FHA or a VA loan, you don't need cash out, you don't need to debt consolidate, but you bought the house within the last couple of years and your interest rate is above 5.5. Let's definitely talk about getting you guys into a lower interest rate to save yourself money monthly. I can see that Michelle jumped on and says, can you tell where the interest be next January if it is lowered now? When is the next change? So, Michelle, that's a great question. There is absolutely no way for me to tell you where interest rates will be come January. If I had a crystal ball, I would not be doing this show with you guys on Wednesdays. I would be sitting in the laps of luxury, swimming in the pool and doing nothing all day because I'd know exactly where to put my money and when. There's just no way to know where interest rates will be come January. But we can talk about, and which I had mentioned before the break, that it is really important for us to discuss what's going to happen next week. Everything in this industry, everything in mortgage is very short term. We don't know from one day to the next exactly what is going to happen. Mortgage interest rates are not tied to the Federal Reserve prime rate. So I'm going to say that again, and I'm going to say it really loud. Mortgage interest rates are not tied to the Federal Reserve prime rate. Although many people do not understand what that means, I'm going to explain it as I have in the past. The Federal Reserve prime rate, when it changes, when the interest rate gets cut, the things that you're going to see an immediate change in are going to be adjustable rate loans. Home equity lines of credit that are adjustable, you will automatically see that interest rate drop because the majority of those lines of credit are based on the Federal Reserve prime rate as one of the factors that indicate what interest rate you are getting. There is usually the Federal Reserve prime rate plus a margin, okay? Car loans. Car loans are short-term loans. Those are 5-year loans, typically 6 years, sometimes 7 years. You're going to see interest rates at your car dealership start to drop. You're going to see the opportunity for interest rate refinances on your cars. You're going to see those interest rates drop. credit cards. Credit cards are directly connected to the Federal Reserve prime rate. So as they start to cut that prime rate, we're going to start to see those minimum monthly payments that we're paying on those balances that we have start to come down and get a little bit lower. So those are going to be things that are going to have immediate changes. Now, mortgage interest rates are not tied to the Federal Reserve prime rate, although I absolutely love that we've got cuts coming and they are going to eventually bleed into mortgage interest rates to help our rate sheets. That's not exactly how it works. So the way that it works is just like the stock market. People move their money around, investors move their money around based on what stock they think is going to be hot, what the market is doing. Do they want to put it into longer term investments such as mortgage bonds, notes, and securities, right? And treasuries. Is that where they want to put their money because they're concerned about things that are going to tank the stock market, going to hurt the stock market? They want to put their money in something that is going to be a little bit safer, right? So as these investors are hearing about rate cuts coming, as they're starting to move their money around, as we're hearing the report come out about inflation, and inflation is getting better and retail is starting to cool and the economy is starting to cool. All of these investors are moving their money around. As they're moving their money around in anticipation of what the Fed is going to do, that starts to change our rate sheets in mortgage. So we are already seeing the benefits to the investors believing that next week that the Fed is going to cut rates. So will they cut rates? Obviously, it's a big question mark for us to all watch, wait, and see. What the biggest question right now is just about 99% of analysts believe we've got a rate cut coming next week. It's going to happen when the Fed meets. Okay. But how much of a rate cut are we going to get? Are we going to get a quarter? Are we going to get a half? Right? So that right now, for the last week and a half to 2 weeks, the majority of analysts believed that we were going to see a 0.5% rate cut next week when the Fed meets next week. So next Wednesday, tune into my show and we'll talk about what happened, right? What did they say today? And what's happening with the rate sheets, right? What's going on with the market? So most were believing we were going to see a 0.5% rate cut. So if we get a quarter rate cut, well, they overshot. So we could, even with that quarter rate cut, we could very easily see interest rates go up. We could see our rate sheets get worse. If we see that 0.5% rate cut, fabulous. That's what everybody was anticipating. Things are probably going to stay pretty status quo because over the last 2 weeks, they've already been building that in to the anticipation of what is coming next week. Now, if there's no rate cut at all, we could very easily see interest rates get worse. So it's all about anticipation with mortgage rates. So to answer your question, Michelle, I have no idea where we're going to be at in January. I would love to see the Federal Reserve cut rates. Obviously next week, cut them again in December. That would, next week, September. So it's going to be late November, early December. It's every 6 weeks that they meet. But I would love to see them do that again. I believe it's late November that we would see their next meeting. I don't have it in front of me. But I'd love to see them start cutting the rates now over and over again, because what does that do for all of us? Obviously, it will bleed into the mortgage rates and things will get better. However, where it's really going to help a lot of people is going to be in being able to refinance their car loans for better monthly payments. It's going to be helping in the interest that you're paying on the balances that you owe on those credit cards. It's going to help with, student loan financing. It's going to just help in general to start bringing costs down for the economy. So I am very much looking forward to that. We are there. We are at that point. We are going to start seeing those rate cuts. And let's just hope that the rate cuts continue, that we don't start to slide back. Inflation doesn't start to, get worse again. So again, it's all give and take. And there's just no way for me to say where things will be in January. However, if you are struggling right now, so this brings me to the point of where I said we've got to talk about, do you start your loan now or do you start it next week? Well, you're hearing me tell you, we already have interest rates that are built in today, assuming that there is going to be a rate cut next week of 0.5%. So if we get a 0.25% rate and you didn't call me today and you wait until next week to call because you heard they cut rates, you actually might be getting quoted a higher interest rate than what we're talking about today. What is the most important thing is that you're making the decision to do the loan at the time that you and your family needs it. If interest rates drop further, there's always the opportunity to do another refinance and to lower the interest rate further and to lower the monthly payment further. But what we need to do is to get you guys into good shape and to get you into a monthly payment that you can afford, and make sure that if that is what you need today, does it make sense today? What is the best option today? Strike at the opportunity and do it. And then if we get the opportunity to do it again, we'll do it again. But we need to make sure we get you into, the right loan today. And if you need it today, you should be doing it today. Michelle, let's see. So that was Michelle's question. Annette says, how long before I'm ready to buy? When do I start the loan process? We are selling our house to buy a new home. Annette, if you're going to sell your new house to buy a new home, that's fabulous. I love to hear that. It's people like you that is going to help us get more properties on the market. So that helps new buyers as well. But as far as when should you get pre-approved, you need to make sure you get pre-approved before you list the house for sale. The last thing that you want to do is to put the home on the market. You get an offer, you're in escrow, you find a house, you love it, you call to get a loan, you apply, and you find out you've got a problem and your house is already wrapped up and under contract. So best thing to do is to make sure that you reach out prior to signing that agreement with your real estate agent to list your home. I would say 30 days before you're ready to sign on the dotted line to put the for sale sign in the front yard is really a good time frame for you to reach out and talk to us and let us help you get pre-approved. Once you know you're pre-approved, then you've got that confidence of putting that for sale sign in the front yard, signing that contract with your real estate agent, and getting things moving forward. So do about 30 days before you're about ready to sign. And why do I say 30 days? You could do it obviously a shorter time frame before that. But if there's something that we need to work on, talk about, maybe, to get you into a better option. So maybe we want to pay a credit card or two down to get the credit score up a little bit. It usually takes 30 days, for that credit report to update with the new balance, to get you a better interest rate when you go to purchase. So it just kind of gives us time to help you and to coordinate and to give you all of your best opportunities in advance. But I don't care if you call me the day before you sign the listing agreement, just please call before you sign the listing agreement. So that would be my best advice to you. Michelle says, what is the differential in rate between owner occupied and investment property? So that's a great question. And I'm going to give you a very vague answer because it really depends on the loan type that we are doing. It depends on the loan size, whether you're a jumbo, whether you're conforming, and all that good stuff, right? But to give you an example, we're talking today about really mostly I've been kind of talking FHAs at about 5.5. If you're doing a purchase today on a conventional loan, you're going to be right about 6 to 6.25. Investment properties, I just quoted one out yesterday that was at 6.875. Again, everybody's a little bit different. So there's about 0.5 point to about 0.75 point. So 0.5% to 0.75% different on average in interest rate between a primary residence and an investment property. So there's your question there. She has another question for me. She says, I have one investment property purchased in November of 22 for a 7-year term fixed at 5.325. So should I refi now? Is the rate low enough for investment properties to refi now? So no, Michelle, I would tell you no. You've got that interest rate at 5.325. We are not there yet for investment properties. You've got a 7-year term that you locked in 22. It is 24, which means that you've got 5 years left at that low interest rate. So you, my friend, have the time to sit and wait and watch and see what the market does and try to, time it out perfectly. But for you, I would say no. I would say this is not the time for you at all. Not if all you want to do is to just refinance to get into a 30-year fixed from a 7-year arm. No, sit on it a little bit longer and wait and see what happens. All right. Annette says, do interest rates go by? And Mikey, can you scroll up just a little bit for me? I'm stuck. I can't see behind the heart. See Annette's question. Do interest rates go by? Oh, credit scores. Okay, I could see it when you kind of move that. So do interest rates go by credit scores? And yes, they do. So the higher that your credit score is, the better that the interest rate is that you will get. The same interest rates are also based on your loan to value. So whether you're buying a home, how much is your down payment? How much of a percentage is the down payment? Or if you are refinancing, how much equity do you have in your property? So the lower the loan to value, the bigger the down payment, or the more equity that you have in your home will give you a lower interest rate. So we've talked about what creates your interest rate, and that's why I say everybody gets a different deal. Your credit score, the equity in the property or the amount of the down payment, the property type. So are you in a single family, condo, townhome, 2-unit, a duplex, 3-unit, 4-unit? Is it owner occupied, investment, second home? So what is the occupancy? There are many, many things that are factors that go into what is your interest rate. Are you going to impound your property taxes and your homeowner's insurance, or do you like to pay those separately? You don't want them to be part of your monthly payment. That's another factor. Tons of factors go into what interest rate you will get. So to be the person that runs commercials that says, call now, I got a rate for you guys, it's 5.49%. That's not fair. It's not fair because not everybody gets the same interest rate. And so then I would be doing these huge disclaimers at the bottom. APR, blah, 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 blah. And you don't hear what that is, but I am baiting you to call me for something that is not available to you. So this is what I'm going to say. If you are in need, you have debt, you're trying to buy a home, you need to be pre-approved, you need to get a second, you need to get things consolidated, you need a big second. If you are in need of financing, pick up the phone and call me, and let's figure out what the best scenario is for you. Does it make sense? Does it not make sense? Where are we at? Can we get the payment very similar to what you have today? If you're trying to pull out some cash, can we drop the mortgage payment that you have today? If you're just trying to get a better loan, a better interest rate, a better monthly payment, the best thing to do is to reach out. We don't bite. We don't bother you. We don't continue to call over and over again. We have the conversation. We lay out the options. We show you the numbers, and then we decide if it is something that we should or shouldn't do. And ultimately, it comes down to you and whether it makes sense for you. So Annette says, we have 500,000 in equity right now. So Annette, you are great. That is awesome. You're going to be able to sell the home, take the money, put it down into the next property. All of that is fabulous. But one thing to keep in mind is that many people, they're like, well, I've got 500,000 to put down. I mean, that's huge. And it is. But at the end of the day, there's still a loan that you need to be able to show the ability to repay. So we're still going to do a complete application. We're still going to verify that your income is enough for you to qualify to make the monthly payment of the loan that you want to get into. So if you are thinking about selling that home, like I said, just reach out before you sign the contract. That's the most important thing. You're probably totally fine. You've probably got tons of money that you can put down. Your credit score is probably fabulous. You're probably in great shape. But let's just make sure that we tell you that, and then you feel super confident signing that contract and listing your house for sale. Because once your house goes under contract and you are selling that home, it is difficult to unwrap a contract that's already been signed. So we don't want to get you in a situation where you end up selling your house and you've got no house to go to. So that's the thing that we just want to avoid. Michelle says, what if I take the rental back and live in it myself after November, even though I also have another home with where I currently live in? Michelle, I love that you're scheming. Basically, that's what you're doing right now. You're trying to figure out a way to get that loan into that 30-year fixed rate. So let me just say this. Mortgage underwriters are not dumb. They know if you're trying to pull one over on them. Many people have investment properties that they move into. They sell the home that they're living in and they move into the rental, and that becomes their new primary residence. That makes sense. And in that situation, you'd have no problem doing that. You move back in it. We do the refinance. It's your owner occupied residence, and you lock yourself into that 30-year fixed rate. But if you're living in a home and you decide you're going to rent that one out, and you're going to move into the rental to call it your owner occupied, there's some question marks going on there. It doesn't necessarily look like it's on the up and up. So there's going to be a lot of things that they're going to dig into, that they're going to ask for. They're going to ask to see utility bills, for water, trash, gas, TV, Wi-Fi, internet. They're going to want to see that you are truly living there. Show us proof, credit card bills. They're going to want to know that you're truly living there. So although that is a great option and one that you can certainly do. So if you truly choose to move out of the property that you are in and move into your rental and live in your rental, you'd provide us with the utility statements to show the proof that you're living there. You'd show us the lease agreement, the rents coming in from the new tenant living in the old property that you departed. There are ways that we can do that, but they'll figure it out if you're just trying to pull a fast one. So in your scenario, if that's the situation, I'm not saying it is, but if that's the situation, then I would tell you to, again, you've got a 7-year fixed rate. You got 5 more years to go, 5 years for interest rates to come down some more down the road. I'd sit on the rate that you have and I'd wait just a little bit. So that's just my opinion, but read between the lines and kind of figure out what I'm telling you. So with that, I am going to take a super quick commercial break. And for anybody that's interested, I'm going to go through that second scenario of a client that we're helping right now to get into a better position, and the opportunities and the options that we gave them. And then we'll close out the show. So stay tuned. We'll be right back.
She's the mortgage mom.
This is Debbie Marcoux, the mortgage mom. Well, I've had a lot of questions lately. What can I do to bring my monthly payment down until interest rates get better? Well, if you are a buyer and you're out looking at homes, what you want to focus on is a program called a 2-1 buy down. If the market rate today is 7%, you would start your first year at 5%, year 2 at 6%, and year 3 through 30 would be at that 7%. It's a great way to enter the market today, knowing that rate cuts are just around the corner. Give us a call or head on over to our website at mortgagemomradio.com.
Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926.
When you're in need and don't know where to go, pick up the phone and call mom.
Okay, so welcome back to Mortgage Mom Radio. I'm Debbie Marcoux. I am the Mortgage Mom, and we're talking really mostly refinances today because interest rates are finally falling to a point where some people can start to get relief from possibly doing a refinance. Right before the break, I was talking to Michelle, and she asked one more question. She says, I am not scheming anything. I don't want to ever rent it again, and how long utility bills I need to show. So the one thing I do want to say to you, Michelle, is that when I said you're scheming, that was not actually in a bad way. I absolutely love it when people start to think about different scenarios and how something that they do, the actions that they take could end up benefiting them. So I do want to point that out. There was by no means was I trying to be rude or call you out on something. I loved the creativity of where you were going with it. And I am personally getting creative all of the time like that, trying to figure out how to help a client. But what my point was is that the underwriters can typically read between the lines to figure out if you are truly going to be living in the property or not. So a couple of things to keep in mind in that scenario, which I absolutely love. I would love to see you move back into it. Make it your primary residence if you don't ever want to rent it out again. So number one, they're only going to need one month of utility bills, because obviously it would be rude for us to say, well, show us more. You could have just moved back in there 30 days ago and you'd only have one month of utility bills. But what they're really going to be looking at is what are you doing with that departing property that you were living in. So if you're going to sell it, that's fabulous. Show us that it's listed for sale. Show us that it's on the MLS, that that your goal is to get that property sold, and that's why you're moving back into the other house. If you want to rent that property out, that's fantastic, but it's got to be rented. So you're going to have to show us a lease agreement for the new tenant, the deposit check that the new tenant gave you, and that it cleared your bank bank account. So again, they're just making sure that that truly became the rental and that you truly moved into the new property for it to be your owner occupied residence. So I hope that that helps. And I'll keep answering the questions. So Michelle does say, I don't want to rent out the home I currently live in. So how does that look to underwriters to have 2 owner occupied homes? And honestly, Michelle, that would be really hard. Now, again, see, this is where the creativity comes in, right? And this is where I start scheming. So I just want to make sure you didn't take that personally. But where you live today, let's just say that you live in Anaheim, and I'm just going to throw a city out there. You live in Anaheim, and the property that you want to move into is in Anaheim. That's going to be really hard. They're not going to go for 2 owner-occupied residences that you're just keeping 2 homes occupied by you. They're just not going to do it. I can tell you that. Now, if you have a home that's in Riverside and you have a home that is in Anaheim and they're at least 60 miles away from each other, then one could be considered a second home or a vacation property, and the other could be considered an owner-occupied property. So again, every single transaction that we do, interest rates and loan programs and loan types alike, are all based on each individual person. What do you have going on? Where do you own it? Where do you live? And we're going to look at all of it to determine what the best opportunity is for you. So with that, Michelle, I'd really just say for you, for your scenario, let's just talk. Just call my office, ask for me, and let's talk. Let's have a one-on-one and let's discuss what properties did you own, where are they at, what are the interest rates, where do you live, which one's the current rental today, and let's just absolutely talk about what those opportunities are, for you, and determine what options might be available to you. All right. So, Tom jumps on. That's my dad. It is his birthday today. So we're going to say happy birthday to Dad. So Dad, thanks so much for jumping on and saying hi. Love it. And I hope you're having a fabulous birthday. And let's go. So let's move on to that last scenario that I promised, and then we're going to wrap up the show. So in this scenario, we've got a client that has a current first mortgage and a current second mortgage. So again, another client that's got a first and second already. Their first mortgage is at a very low interest rate, but they've got a second already, and they are looking to extend the second mortgage that they want. They want a second mortgage, not a home equity loan. Their their credit scores are actually quite a bit lower than what we would like to see, but we're still here to help and we still have options. So we've got many investors that will allow all different types of scenarios. So don't believe that if you don't have a 700 or you don't have a 740 or you don't have a 680 that there's nothing that we can do for you. There are things that we can do. So in this scenario, the client has a 636 credit score. We actually worked with them to show them what options were available to get the credit score to at least a 640 so that we could refinance their current second for a new, bigger second, leaving their current mortgage in place right where it's at. So that's number one. We're always going to give you that opportunity of what can we do to improve the credit score to get you to qualify for a product that maybe you're not, qualified for today. However, with a 640 credit score, the interest rate on a home mortgage on a second, so doing a second home equity loan, will be significantly higher than what it would be if you did have a higher credit score. So in this scenario, to get a new second mortgage for $175,000, so they wanted to rewrite the $100,000 they owe, and they wanted to get a new one for $175,000. That interest rate was actually going to be 13.849%. 13.849% for $175,000 second for a home equity loan. So that is a very, very high interest rate. And because it's a loan and it is principal and interest, that monthly payment was going to be $2,053 for that $175,000 loan. So if we take their current mortgage that they owe today at $3,700 and we put that together with the $2,053 for the new second, that monthly payment was $5,769. If we do a refinance and we consolidate the first, the second that they owe, and we get them the cash out that they want in hand, so basically instead of extending the line, we're consolidating it all together in one. That interest rate for them, again, lower credit score. We don't have to do any repair to get to the 640 because now we're going to do an FHA debt consolidation, refinance all into one. A 636 credit score is more than acceptable for FHA. Interest rate at 5.625 and monthly payment $58.40. So their current payment today is $37.16, and they're also paying a second mortgage that was right about $900 a month. So a new payment with the cash out on FHA was their absolute best option, doing it all in one brand new loan, paying all their debt off, getting their credit scores up because all their debt gets paid off after we're done with the loan. $5,800 a month for them. So FHA in this scenario was by far a way better deal, way better loan than giving them $175,000 at 13.849%. So again, many people are in this scenario. I don't fault anybody. We've all had a very rough, difficult 3 years, very difficult 3 years, and we're all just trying to make it through. So if you've done the refinance, if you've pulled the equity line of credit, you've tapped all that out, now you've tapped out those credit cards again, there very well still might be an opportunity for us to help you to get things back in shape. Now, again, one more time, I'm going to say this. We're going to help you get back in shape. We're going to help you get it all consolidated. We're going to help you get it paid off. We're going to help you get that interest, that FICO score back up because you're paying off the debt. But get strict with yourself. Do not do it. Do not reuse those credit cards. Do not go take out new personal loans. Do not pay off a car and then go trade in the free and clear car and go buy another one. You guys have got to live within your means. It's really important. Let us help you. Let us help you get to where you need to be. Let us help you to get consolidated. And if you need to, call your mom, call your dad, call your sister, call your brother, call your best friend. Go drop off your credit cards. Tell them to put it in their safe and do not touch them again unless it's an absolute emergency. So with that, I just want to say there's tons of options out there. Purchases, you guys, if you got pre-approved about a month, 2 months ago, 3 months ago, reach out to us, reach out to your loan officer, find out if you can get pre-approved for a little bit more. If you couldn't quite get what you needed, if interest rates are down, you qualify for a little bit more. If interest rates are down, the monthly payment that you were quoted is going to be a little lower. So lots of opportunity right now with interest rates coming down. It's very exciting. Once again, how do you guys call us? It's 844-935-3634. That's 844 We Lend for You. WELEND and the number 4. And so let's see, Michelle did have more questions. She says, if it doesn't help at all in getting better rate, even if FICO is in the 800s, I experienced that, but don't understand why that is so. Then why do I need to get higher than 740? So every loan program is different, Michelle, and this is great for everybody to hear. Every single loan program is different. So it depends on the loan program that you are going after. A conventional loan with Fannie Mae or Freddie Mac, 740 is going to be the top tier of where you get the best interest rate. So any credit score above 740, everybody gets the same. On a jumbo loan, there are many lenders out there that will say 780 and above get a better interest rate than somebody at 760 and that somebody at 740. So obviously we all strive to have the very highest credit scores we possibly can when it comes to financing. It definitely makes things much easier. If you've got an 800 and 820, it puts you in a superior position of being approved for a loan. But again, depending on the loan program that you're looking at will determine what the very best interest rate is based on what that top tier credit score is for that program. So I hope that you guys all enjoyed this. Nikki jumps on and says, great information today. Nikki, love to see you. Nikki is my favorite favorite real estate agent here in Lake Havasu. So if you guys are looking to come out here and buy a home, buy a second home, sell a home, Nikki Goudreau, I'm telling you guys right now, she is your girl. The lady is amazing. But Nikki, thanks so much for joining as well. I hope you guys all enjoyed it. I hope you come back next Wednesday to find out what the Federal Reserve does. Do they cut rates? How much do they cut? And what do we see going on with the market? Are the rates actually going up even though they made a rate cut, or are they staying the same? Or are they getting better? We don't know until next week. So talk to you guys all real soon. Bye-bye.
Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's a mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.